From the morning reading, bull flags bounce. We hope you are watching as suggested the Monday Post. Uptrend resumes in the spiders, diamonds, IWM, and Qs. All 9 sectors moved higher on Tuesday. XLE, XLI, and XLB were the strongest sectors, while XLU was the weakest sector. Oil futures rose 141 to close at 44.65. Breadth strengthened as advancers led 23.37 to only 7.10 on the New York Stock Exchange and led 16.76 to only 9.13 on the Nasdaq. The S&P 500 snapshot up 1.25%, best gain in 2 months. U.S. equities rallied today on a balanced move across the big 3 indices. The Dow and the Nasdaq rose 1.26%, and our preferred benchmark, the S&P 500, posted a gain of 1.25%. The 500 surged in the opening minutes and continued to rise at a relatively steady pace throughout the session and finished the day just a couple ticks off its 1.27% intraday high seconds before the close. The index is now up almost 2% year to date and about 1% so far in May, so the proverbial sell and go away month doesn't seem to be following through at this point. Today's advance was the biggest since the 1.64% pop on March 11th. Why the strong gain? Oil was up, with West Texas Intermediate crude up over 3.25%. And this morning's favorable JOLTS report probably reduced concerns over Friday's mediocre April employment report. New 52-week highs dominate the New York Stock Exchange, but not the Nasdaq. For the past week, there have been more securities that traded at a 52-week low than 52-week high on the Nasdaq. On the New York Stock Exchange, new 52-week highs have been overwhelmingly dominant to the degree not seen in at least 30 years. That dates that come closest were in 2001 and 2008. A lot of put options were traded on stocks on Tuesday. The equity-only put-call ratio jumped to 0.90 despite a hefty rally in stocks, something that hasn't been seen since 2008. The 5-day average of the ratio is now the highest since February, but its long-term record at preceding rallies is only mixed. Near-term volatility expectations drop compared to longer-term expectations. The term structure in VIX futures moved to one of its lowest readings in the past 3 years, which has not been a positive sign for stocks as they've struggled over the short to medium term when that ratio has dropped below 0.8. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:42 a.m. Central Time, and I'm recording this in preparation for the market day of May the 11th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and bounce over to the morning report. And action thus far is just a little weak, but nothing serious. All 4 broad market U.S. indices are down right at 0.25%. Crude oil's up about 0.33%. Euro's up about 0.25%. Bonds are up just over scratch, and gold is up about 1%. And overseas action is pretty mixed. China just up over scratch. Hong Kong down nearly 1%. Japan up just over scratch. Germany down about 0.75%. And the United Kingdom down about 0.25%. In terms of U.S. macroeconomic reports of note for today, you do have the crude oil inventory report and a 10-year bond auction. You don't see much else to note. Looking forward to tomorrow, we have the weekly version of unemployment claims, import prices, FOMC member Rosengreen speaking, a 30-year bond auction, FOMC member George speaking, and that should pretty much take care of Thursday. In terms of current volatility conditions, as you would expect with yesterday's action, We continue to get lower with volatility, and you see the 5-day versus 10-day has been decreasing. Short-term VIX down below 13 now with a 12.8 at the close. Skew also benign. IV percentiles, look at how low these numbers are getting. 3 of the 4 into single digits. The S&P at a 5, the Russell at a 6, the NASDAQ at an 11, and the Dow at a 7. We did put a standard deviation move yesterday. In fact, all 4 of the U.S. indices were up over 1 standard deviation move on a close-to-close basis. That was after having 4 trading sessions with no such activity. In terms of So in terms of the charts, let's start with the S&P futures, and you see the recent action where we've come up this very strong channel to the significant area of resistance, turned on a dime, and been falling for 2 weeks. Now we've had this flag pattern, which has broken out big time yesterday, and you see it took it, where did it go? And we talked about this yesterday, that if we were to move up, where would we likely stop? And it's just amazing how that did that. Look at that. It closed right at the line that we've had drawn for days. It tickled up above, but closed just below. And price action so far is stalled in that area and has not gotten up through there. So we're up against a kind of significant area of resistance. Not as significant as this one up above, but certainly, you know, the first place where the bulls would be expected to run into some trouble. And that seemed to stop yesterday's advance in its tracks. So where do we go from here? Well, an expectation is that if this indeed was just a complex consolidation and a bull flag, we should continue the prior trend and we should continue to move up and back to these prior highs. We'll have to see if the bulls truly have any follow through and are able to get through the first major test in this most recent advance. So today will be quite an interesting day. We've had kind of some split, and you notice one of the morning authors mentioned how the new highs, new lows, and so forth are really quite different when you look at the NASDAQ versus the S&P. More specifically, the New York Stock Exchange was the reference I believe the author and the morning reading made reference to. Well, you know that NASDAQ has been so much weaker of late, and indeed has been chopping around in the cloud and has a lot of room to go before it gets back up into even the former swing highs. Forget about anywhere near the all-time highs. So this is relatively much further back. The Russell is also performing in a similar way to the NASDAQ, though it wasn't noted about having, you know, the new highs, new lows to such a divergent degree versus the New York Stock Exchange holdings. So kind of keep this in mind. Where do we go from here? Are we just going to have a lower high on these markets, or do we actually achieve something? And it's been so difficult to actually achieve anything. So we're watching to see, are we just really in a range, and are we going to actually just roll back over and just play back and forth, or did we actually achieve something? Let me go back to the S&P futures here. There's something I noticed yesterday that I wanted to draw your attention to. So we had this big move. So you had the big move here, and then you had these series of short-term lower highs, lower lows, lower highs, lower lows, and then of course you broke that pattern with this big up thrust here. Well, when I look back, I wanted to see if there were similar kind of patterns, and indeed where we had this rip your face off run here, then what happened? Well, we had, you know, we took out some of the support, we undercut it and so forth, and then we came back with these big candles here, big engulfing bullish candle here, ran back up and then just stalled again and continued to kind of chop sideways before eventually breaking down into the January-February breakdown. So the fact that this pattern here, you know, had something of a rally out of it after kind of breaking the initial diagonal and horizontal support, and then rallied a little bit just to kind of peter back out and eventually run back down, made me wonder if that might not be what we're going to see here again, where we've had this break of the diagonal right here and break of the horizontal support right through this area. And then we get this big rally just to, again, exhaust and then fall back down. So that's one pattern, you know, possibility. Frankly, probably, in my opinion, not the leading candidate, but it is one possibility. And again, it kind of goes back to the strength of this overhead area of resistance, you know, ultimately trumping everything. Now, the preferred potential at this point is that we just go into a summer doldrums and we just chop between the cloud area and this area up here, and we just go back and forth, and just kind of achieve nothing really in terms of actually making any profit on your buy and hold or your core portfolio positions, but also don't see a significant deterioration. When we look at the big picture and the fundamental indicators of the economy, you know, there's clearly some that are pointing to weakness, but there are others that are holding up fine, such as the employment reports and so forth. Though there's been some recent action to cause the employment report to take a little bit of weakness. So when you kind of put all this together, it's hard to make a case for new highs. It's also hard to make a case for that we're about to have a 20% correction, bear market size, coming out of these indicators or out of these charts. So it's a bit of a mess. I'm probably a bit of a mess just in trying to describe this to you, but I think that's what we're looking at. And until we get new information or new energy, that's probably the most likely scenario. So just kind of keep that in mind as you're trading, and be very, very judicious with the initiation of new bullish, especially short to medium term trades, because this is a very difficult place, and patience is probably in the end going to be rewarded in the face of these kinds of circumstances. We'll take a look at bonds, see if that's leading us to anything, and really it's up against this area of resistance that we talked about. And so it's kind of hard to believe that the bonds, you know, go much further up, which would also, of course, in the inverse, tell us something about what to expect of equities. Volatility getting relatively low, and in fact, if the VIX can drop just a little bit further, I mean very little bit, I would be inclined to start setting up some volatility hedges, vol bombs, calendars, or just various different ways you can play this. I probably would also be looking at buying some long-term protection with the SPX puts. That's the kind of range that we're getting into, and if we can drop below 13, I'd be very inclined to put some of those on, especially given how unstable the market has been in recent months. In terms of gold, we'll give one quick look over there to gold, and again, just this big patterns seem to work, but in the small, you seem to have a really choppy time on being able to get there. So far, with last night's overnight action, we're seemingly coming back up off this swing bottom. We'd like to see this break this area here and create a new flag and then take off for another leg up is kind of what we're expecting there. We can take a quick look at crude oil if you would like. Crude oil certainly has had an awful lot to do with the equity market of late. And you notice just about the time that the equity market turned, well, guess where, an awful lot of that energy was coming from? It was from crude oil. That's why I decided to go ahead and take a look at this today. Seems to be in something of a consolidation pattern, but the least surprising move would be to continue up, and that would be supportive of the equity market also moving up as well, given the recent correlations and movement between these two. That doesn't always happen. So that's probably enough on the charts. Let's go ahead and wrap up with our daily report. Not a lot of changes from yesterday. We're still phase 5 on the market trend intermediate term phase opinion. The in short term, we've had that most important break of diagonal and horizontal support. We're waiting to see if we truly set up a pattern coming back up. In terms of the market timing signals, the first one, uptrend under pressure from IBD, that's in caution. The second one's also in caution. GMI index has got a sell signal that's been issued since 5/4, and that author is mostly in cash. And our third market timing signal, which is mechanical as well, comes from stock charts decision point, and you notice the short term continues to have a very, very poor structure, and indeed overall this is a very poor stack between the short, intermediate, and long term here, and this is certainly reflective of the mess that these charts are in, and mostly in a sideways pattern. Position sizing opinions, no change from yesterday, still at 50% for portfolio, 75% for active trader vol base. In terms of intermediate term market posture, we did have some changes here, and with yesterday's strong action, we actually went to weak bull, a turn up on the S&P, which is most important index. The Dow as well as the Russell all turned up. Its first day turn up, I call the mechanical signal as it is, and yet at the same time, I always make note when we're in a first day turn like this, I often see failure with these kinds of signals, and we'll want to see that this actually starts to build and follow through and not just roll over in the next day or two, as is often the case. In terms of hedge warning status, no change here, still level 1 plus caution, with a reflection on those increasing number of warnings that have been firing of late. Strategy opinions, VIX is inside the acceptable window. Option income strategies may very well be the best way to trade in the next few weeks, given the expectation of summer doldrums and low volume trading. So kind of keep that in mind, yet be defensive to the aspect that if this is to break down, you could have larger than expected Vega and Delta moves. Cover call strategies. Conditions I still have here is not acceptable. Technically, we went into that intermediate term market posture turning into weak bull, which would give us permission to initiate new trades. If you're a particularly aggressive trader, you might, start to pick up a few positions using a 1-to-1 ratio of in the money, out of the money strikes, also a 1-to-1 ratio of low beta and high beta positions in your portfolio. If we do get follow through the next day or two, I'll probably upgrade this to conditions acceptable to initiate new positions for novice traders. Still a bit timid about that. I've seen so many of these turns reverse after a day or two when they come where they did on the chart in this case. In terms of specific warnings, you see we still have this volatility ratio warning that's in the reversal zone waiting a fire signal. If that fires, that means volatility is going up and probably equity is going down. We did actually come down a notch on the distribution day count with yesterday's close. NASDAQ now at an 8, S&P at a 6. We still have all 5 of the key intermarket risk aversion indicators as risk off, and I'd like to see some of those improve if we're really to start a new bullish leg. In terms of sentiment indicators, relatively benign on the stocks, though bonds and gold a bit elevated, so watch for potential reversal patterns there. Fear and greed index actually ticked up a little bit yesterday. It was from the prior day a 60, went to a 65, so still relatively in the general neutral area, but starting to move a little closer. At 75, we certainly move into the more extreme greed quartile. In terms of sector specific, a lot of improvement yesterday, but keep in mind that some of these are actually pretty flat and tightly wound, so they go and they flip-flop from up to neutral to down, and price just had a big day yesterday. It was the biggest day in a long time, and yet at the same time we come back with one big down day, and these will all turn red. So that's the kind of nature most of these are in. We've had a lot of this happening in recent months where the market being so sideways, these indicators get really sideways themselves. Percent change, big day yesterday, as you can see here. Everybody was up. Even utilities, as the last place sector, was also up. There was a lot of money pouring into the higher beta areas, and risk on was certainly the behavior of where an awful lot of the market was going yesterday. And you notice down here at the bottom, telecom, consumer staples, healthcare, which biotech is not low beta, but the other parts of healthcare often are, and then utilities. So all the most defensive sectors down here at the bottom of the stack, and the higher beta was, at the top of the stack. So it was a very, very significant day yesterday for the bulls, so we don't want to diminish that one bit. Yet at the same time, we would like to see some follow through. In terms of the ETFs that are in intermediate term market posture, no change there, and it's still a very broad dispersal pattern between high beta, low beta, defensive, non-defensive, or risk on type of ETF. So that still continues to hold up and be a sign of strength for the bulls. So we're just over 20 minutes now, so I'm going to go ahead and roll through this wrap up section. If you see something of interest, hit the pause button and then go to the hyperlink to get additional information. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And then, of course, always note the full set of disclosures can be found at this hyperlink down here at the bottom. We'll see you back here tomorrow morning with the Falcon Global Market Preview. In the meantime, good trading.